Good day, everyone, and welcome to our latest Market Insights presentation. Today, we're focusing on a very significant event in the Dhaka Stock Exchange. On this first slide, you'll see the title. As of March 10, 2026, IIDFC Capital Limited Market Intelligence Division. This marks the beginning of our March 2026 Market Intelligence Report. We'll be discussing the major market crash that's been the worst since the COVID-19 pandemic, with a decline of 8.67% over just 8 sessions. Stay with us as we explore what led to this crash, its implications, and what it means for investors moving forward. Let's get started. Today, I want to draw your attention to a particularly significant day in our market history, March 8. This day is marked as the worst day drop, with the market plunging by 232 points. To give you some perspective, prior to this crash, the market was at a 52-week high of 5,675 points. On that single day, the market experienced a massive loss, and the total market capitalization shed approximately 13,400 crore taka. That's a substantial blow, reflecting a 56% collapse in trading volume, which indicates a huge withdrawal of investor activity. In terms of daily turnover, it was around 416 crore taka, again, the worst since the COVID pandemic, highlighting the severity of the sell-off. Looking at the month-to-date change, the market has declined by almost 8.67%, bringing us to a 2-year low. Closing at 5,009, the DSE index shows us just how challenging this period has been. This snapshot, taken on March 10, 2026, helps us understand the scale of the decline and the impact on investor confidence. It's a stark reminder of how quickly the market can turn and the importance of staying vigilant. Let's take a closer look at how the market moved during this period. On this particular day, the market was quite flat, with no significant change in points or trading volume. However, as we progress through the timeline, you'll notice some sharp movements. For example, on March 9, the market plummeted by 232 points, which is a decline of about 4.42%. This was a clear sign of panic selling, and the market capitalization dropped by around TK 13,400 crore. This kind of sudden drop indicates a loss of investor confidence and suggests that fears or uncertainties were mounting. Looking back to March 8, we see a decline of 82 points, about 1.54%. This was part of a sustained sell-off, where institutional investors triggered stop-loss orders, further accelerating the decline. It shows how institutional behavior can influence market momentum during stressful times. Even earlier, on March 5, the market fell by 209 points, roughly 3.77%. This day was driven by fears over fuel supply disruptions, especially after Qatargas announced halts in supply. That day marked the worst performance in 6 years, highlighting how specific geopolitical issues can have immediate and severe impacts on market sentiment. Then, on March 3, we saw a brief relief rally, with the market gaining 72 points, or about 1.32%. It seemed like there was a temporary pause in the decline, possibly due to diplomatic channels opening and investors hopping for some resolution. Finally, on March 2, the market fell again by 138 points, around 2.46%, following a major geopolitical event, the U.S.-Israel strike that killed Iran's supreme leader Khamenei. Such international incidents can quickly ripple through markets, causing volatility and investor concern. All these points together illustrate a period of intense volatility driven by geopolitical tensions, supply fears, and investor reactions. Understanding this timeline helps us see how interconnected global events and local market movements truly are. Let's take a closer look at the sector performance for the month of March 2026. As you can see, some sectors have experienced declines, while others have shown positive growth. Starting with the declines, fuel and power has decreased by 6.8%, highlighting some pressure in that area. Banking has also seen a decline of 5.2%, which could be indicative of broader financial market challenges. Telecom and pharmaceuticals followed with decreases of 4.1 and 3.8% respectively, suggesting some sector-specific headwinds. Engineering and textiles saw declines of 3.5 and 2.9%, while food and allied dropped by 2.1%. On the flip side, we see the IT and technology sector performing quite well, with a gain of 1.2%. This suggests resilience and perhaps opportunities driven by innovation and digital transformation. Most notably, non-bank finance has surged by 5.5%, making it the clear winner among sectors for this period. These movements reflect how diverse industry dynamics can be within a single month, and they underscore the importance of understanding sector-specific drivers in our overall market analysis. This performance snapshot helps us grasp where the momentum is and where caution might be warranted as we look ahead. All right, let's take a closer look at what's happening with our critical support level here. As of now, we've reached 5,009 points, but what really caught my attention was what happened on March 8th. There was a sharp decline of 232 points, which I'd classify as a panic move. That kind of drop can really shake investor confidence and send ripples through the market. If we look at the timeline, we see this significant dip right after a series of declines starting from March 2nd and 3rd, and then again on March 4th and 5th. This pattern indicates a period of heightened selling pressure. It's important to note that these sessions of relentless selling, totaling about 8, have been pushing the DSE index lower, and it's crucial to understand the context around these moves. The overall price action on the DSE shows a clear struggle to hold above that critical support level, which is around 5,000 points. When the market hits these levels, especially with sudden drops like on March 8th, it signals a potential shift in momentum, or at least a fight to maintain stability. Connecting this to the bigger picture, these swings highlight how sensitive the market can be to panic selling, especially around key support levels. This underscores the importance of watching these critical points closely, because they often act as a barometer for future market direction. When you see such relentless selling, it's a reminder that markets can become quite volatile, and staying alert to these patterns is key for making informed decisions. Let's take a closer look at the risk factors driving this potential economic crash. First, we have an 80% probability that the USD 1.3 billion disbursement will stabilize the Bangladeshi taka, thanks to the continuation of the IMF program. This is a positive sign, but it's not a certainty, so we need to stay cautious. Next, there's about a 50% chance that escalating import costs could worsen reserve pressure. When import prices go up, it puts additional strain on our foreign exchange reserves, which are already under stress. On the moderate risk side, we see Bangladesh has struck a wheat deal to partially offset the impact of U.S. tariffs on ready-made garments. This is a helpful move, but it's only a partial solution, so the overall impact remains uncertain. Another moderate risk, with a 30% probability, involves the Strait of Hormuz closure. Since over 80% of LPG imports come through this route, any disruption here could significantly affect LPG supplies. Finally, we have a high probability, about 65%, that oil prices could rise above $120 per barrel, and any supply disruptions from the Middle East could further impact Bangladesh. This escalation could have serious consequences for our energy costs and overall economic stability. All these factors are interconnected, and together they paint a picture of potential vulnerability. Understanding these risks helps us grasp what's really at stake in this economic outlook. Let's take a closer look at the forward scenarios we're considering. First, in the best case, or bull case, we see a ceasefire or a diplomatic deal taking hold. This would lead to oil prices retreating, which in turn helps stabilize the Bangladesh taka. In this scenario, we're looking at an accumulation phase with the DSE index ranging between 5,400 and 5,600. The probability of this happening is around 25%, and we believe the market could reach a higher target in this case. Moving to the base case, or hold and select by scenario, tensions would plateau, and we might see IMF funds arriving, providing some much-needed support. Energy rationing would be managed more effectively, leading to a more stable environment. Here, the DSEX target is between 4,900 and 5,200, with a 40% probability. This scenario suggests a cautious optimism. Markets might hold steady or offer select buying opportunities. Lastly, in the bear case, conflict escalates further. Disruption in the Hormuz Strait could push oil prices above $120, intensifying the power crisis and causing significant market stress. The DSEX index could fall to between 4,600 and 4,800, with a 35% probability. In this case, the recommendation would be to sell or reduce holdings to manage risk. Overall, these scenarios help us understand the potential paths ahead and prepare accordingly. The key takeaway is that the market's next move depends heavily on geopolitical developments and energy prices, which directly influence investor sentiment and the overall economic outlook. All right, let's take a closer look at the technical levels on this chart. We can see that the 52-week absolute low is at 4,588, which represents a critical floor for the market. If prices were to approach or break below this level, it could signal significant downside risk. Moving upward, there's a support zone between 4,700 and 4,800, which we can think of as a support level 2. This is an area where buyers might step in to prevent further declines. Further up, we have what is called support 1, and that's around 4,900 to 5,000. This is more of a psychological support level. Markets tend to react strongly around these numbers because traders see them as important benchmarks. Right now, the current price is approximately 5,009, which is right near that psychological support zone. It's important to watch how the price reacts around this level, as it could determine the next move. On the resistance side, we see resistance 2, which coincides with the 50-day simple moving average between 5,300 and 5,325. This is a key level to watch because it often acts as a barrier for upward momentum. Above that, resistance 1 is at 5,400 to 5,450, and that's a more significant hurdle for the market to overcome. If prices can break through these levels, it could signal renewed strength. Finally, the strong resistance zone is between 5,600 and 5,654, which would be a major hurdle for any bullish move. In summary, these levels form a map of support and resistance that helps us understand where the market might find footing or face obstacles. By keeping an eye on these levels, we can better anticipate potential turning points and align our strategies accordingly. All right, let's wrap up with some key takeaways. First, if we see a clean break below the 5,000 level on the index, it could trigger the next wave of stop-loss selling, which might accelerate the downward momentum. So, it's an important psychological and technical threshold to watch. Next, the IMF's recent deal worth $1.3 billion is a significant positive counterweight for BDT stability. It provides some reassurance and support amid the volatility, but we need to stay cautious of the broader risks. Speaking of risks, the energy sector remains particularly vulnerable. Bangladesh imports over 80% of its LPG through the Persian Gulf, making it susceptible to geopolitical tensions in that region. And those tensions have been heightened by the recent U.S.-Israel strike on Iran back on March 1, which is a primary cause of the current geopolitical shock affecting markets and stability. Finally, the Bangladesh Stock Exchange has shed about 8.67% over just 8 sessions, marking the worst decline since March 2020 during the height of the COVID-19 crisis. This underscores how sensitive markets are to these geopolitical and economic shocks. So, in summary, while there are some positive signs like the IMF deal, the overall picture remains volatile and uncertain, especially with geopolitical tensions and their impact on the local economy and markets.